Welcome everybody, my name is Luke James and I'm from BOQ Specialist. We appreciate you taking a moment out of your day or night, depending on where you're currently located. This is being streamed across all states within Australia. We acknowledge that some of the states have been doing it a little bit tough in recent times due to COVID-19, but we hope that with some of the restrictions being lifted in recent times that you can get back to some level of normality. In this episode of our In the Know webinar series, we will be talking about buying your practice premises via your self-managed super fund. There will be a range of topics we'll be covering off, all of which will be in the agenda. The benefits of purchasing your practice premises through your self-managed super fund. The importance of setting up the legal structure, which Scott from Cooper Grace Ward Lawyers will touch on in more detail. The accounting and tax flow considerations, which Brad from Pitcher Partners will touch on a little bit later. And also the finance process and how to get an approval.
Just as a further introduction, I've been with the bank for a little bit over 7 years now. I look after business finance for dentists, doctors and vets. So that includes self-managed super fund lending, commercial property lending, also practice, goodwill and fit out and car loans as well. We also have Scott. We've got Scott Hay-Bartlem from Cooper Grace Ward with us. Scott is from a Brisbane-based law firm, and he looks after Superannuation, and he's also a director of the Self-Managed Super Fund Association. They specialise in assisting clients and advisors with tax and superannuation advice. We also have Brad Twentyman from Pitcher Partners. Brad is a client director at Pitcher Partners and has specialised in superannuation for over 15 years in both private and public sectors. We encourage you to ask questions throughout the presentation. As you can see, you've got the chat inbox, which I think some of you have already used to let me know the sound is doing better, I believe. So throughout the presentation, we will be taking questions, and there will be some time at the end that we will cover off as many as possible. I'm also just going to put up a quick poll, just so we know where everyone is from. If you could potentially also just locate or let us know where you're currently from. I think there's one at the moment. And let us know how where you're from so we can tailor it towards your needs. There will be some time at the end for us to answer questions, and also we will have our contact details for you so you can contact us directly, and we can provide you with some more, tailored advice to your own specific circumstances. So look, we hope you enjoy the presentation, and I'll quickly get started, just briefly touching on some of the benefits purchased through your self-managed super fund. So there are a range of benefits from, different varied sources. So from your self-managed super fund point of view, you being a doctor, a dentist or a vet, you are the preferred and ideal tenants. Your super fund is going to have the ideal amount of income coming in from the revenue stream of your practice entity. From the practice point of view, you're also going to have that security of tenure. You're not going to have to worry about your landlord not renewing your lease, because relocating can be costly and also time consuming. You know that the money that you're putting in for your practice, so your fit out, your equipment, is going to be a long-term investment. Having a property also in your super fund, it is a growth asset. So the money that you're contributing towards the property, it's better than putting towards the rent for a landlord. There are also numerous long-term tax benefits. What we'll have is Brad from Pitcher Partners, who'll go through them in a lot more detail. I would now like to introduce you to Scott, who will touch on the legal aspect in a bit more detail. Thanks, Scott.
Thanks, Luke. I'm in Brisbane and we've got our second storm of the day coming through. So we'll try with the headphones and see if that can cut out the noise of the thunder in the background. So, Cooper Grace Ward, we do the legal stuff for BOQ Specialist, and I work in the exciting section that does the stuff to do with SMSF. So the biggest issue we find in SMSF borrowing is making sure that we get the structure right, and we'll talk about what that means, what structure we need, how to make sure we get it right, common traps, things that we see go wrong, and talk about some special issues with business premises, because as Luke said, that's really what a lot of you are doing, is putting your business premises into your SMSF, using borrowing to make it all work properly. So where we get to with SMSF borrowing is that generally SMSF trustees are actually not allowed to borrow. So we need to squeeze ourselves within a rule we were never designed to allow SMSF to borrow to do what we're doing. Now, I'm a lawyer. I love my section numbers. I love my detail. Section 67A of the Superannuation Industry Supervision Act is the exciting section we work within to make this work. Now, its section is actually designed to allow something quite different to what we do. So the structure that we have to use to make SMSF borrowing work makes no sense. Okay, no sense. Don't look for logic, look for sense. It's there for an entirely different reason. And there are four main rules that we're working around. The first one is that the asset we're buying has to be held on trust for the SMSF. So many of you will have borrowed through family trust, for example, where it's the family trust that goes and buys the asset and does the borrowing. No. In SMSF world, the super fund is the borrower, but the asset has to be held by a separate trust. And this is the biggest mistake that we see in SMSF borrowing world, is making sure we get that trust set up before we buy the asset, and it's the name of that trust which should go on the contract, but the super fund borrows. The super fund must be able to get title to the assets after paying one or more instalments. The lender's rights have to be limited to the asset. So often you'll hear this called limited recourse borrowing arrangement, or LRBA. It's because the super fund can only be responsible up to the value of the asset, and not other assets of the super fund can't be got out for the borrowing. And the last issue is that it has to be an asset that the fund could have acquired. Now, in years gone by, we used borrowing structures, and we used to do things to get assets into super funds the fund couldn't have bought it themselves. So when we're looking at LRBAs and super borrowing, we are limited by the normal SMSF acquisition rule, so we'll talk a bit about at the end of my section. Okay, so here's a bit of a diagram trying to explain how this kind of thing actually works. So you'll see in the middle at the top there, you've got the SMSF as the center of everything. Now, in the bottom right-hand corner is the actual asset. And in the middle, on the top right-hand corner there, that's their trust. Okay, so the SMSF is there borrowing from the bank, and you see the bank on the left. The bank lends to the fund puts the money into the bare trust, which is used to buy the asset. So this is where the biggest mistake we see, the biggest trap, you've got to get the structure right. Okay, you can't just go grocery shopping and accidentally buy a property, which people do. I go grocery shopping and accidentally buy shoes, but lots of people go shopping and accidentally buy a property. So you've got to have some organisation built in, some pre-planning if you're going to go ahead and do this. And the bank takes the limited recourse mortgage over the property because that's where the asset is. It's owned by the bare trust. Okay. Doesn't make any sense, okay? That's just the way the rules are. It's there because it's designed to allow something quite different to what we do with it. This is now quite accepted as how we can do borrowing and buying assets in SMSF. Okay, so 4 main issues about getting it right. Number 1, in almost every case, the bare trust trustee is the buyer on the contract, and you need to have the bare trust put in place before you sign the contract. That's the cleanest way of doing all this. You need to have a separate trust and a separate trustee which owns the asset. Now, for a number of reasons, that's going to have a company as trustee and a different company to the company as the trustee of the super fund. So if you're going to do all this stuff, you need to have a new company and you need to have our new trust set up to make the super fund borrowing paper actually work. okay? But it's the SMSF is the one that is doing the borrowing. It's really important to know that. The super fund borrows, it's not the name on the contract of the purchase. We've got lots of times we've had to have fights with lawyers about this. That's just the way it works. Now, there's a few issues sitting in here about SMSF borrowing that we just need to highlight. Now, because we act for the bank, we need to make sure the arrangement's going to work. There's a whole lot of questions we will have, and we have to cast our eyes over the arrangement to make sure it works, or else the bank ends up with a problem and you end up with a problem. So, a few things. We can only have one asset. Okay, the rules talk about a single acquirable asset, which is a special thing made up for these purposes. So there's a few issues we see in this. Number one is car parking. Now, every state does car parking differently. Sydney doctors will often buy the premises we carry on the practice from, and then car parks as well on separate titles. We can only have one of those assets in the bare trust. That means we need to have the super fund borrowing in the bare trust to buy the practice premises, but the car parks are either bought by the super fund directly or in different assets. If you've come to the Gold Coast and say to the Gold Coast apartment in Queensland, you'll know that you have the apartment that you go and stay in and you park downstairs. Okay, in Queensland, that's done by rights that the body corporate give you. That's one asset, that's okay. So where we're looking at things like car parking, we may need to ask some more questions to make sure we only have one asset. Things like multiple lots. If I'm buying two lots, then I have to look at two trusts, one lot per trust. And if I'm buying one lot or two lots with one building on it, and the building goes across both lots, we're probably okay. But if I'm buying Unit 8 and Unit 9, even if they're next to each other, even if everything looks like it's one property, because there's Lot 8 and Lot 9, we've got two assets, and that's two bare trusts, not one. Two contracts, two bare trusts, and two loans. Okay, really important. So when you, even though I know to you it's one premises, the way the government's drafted these rules, we need the two trusts. Does it make sense? Just the way it is. Fit out. You can imagine that if you're buying a premises and you're buying dental chairs, or you're buying other medical equipment, or you've got reception desks or chairs, all those kind of things, that's more than one asset. Okay, if it's built in, if it's a fixture, it's one asset. So what we usually have to look at doing is actually separating the fit out from the premises itself. So the super fund using the bare trust buys the fit out on one hand, the practice entity using a separate funding facility buys the fit out. BOQ Specialist can do it, but it's all the time. We need to separate out those two items to make it work under the rules. Second one is, it has to be something the SMSF must have been able to acquire. I'll talk about that more in a second to explain a bit more why that's important. We need to have special loan terms. So when we're looking at this, it's not just an ordinary loan, it's a different loan to if your family trust was going out to buy the property. One example is that limited recourseness. Once we've got the asset in the bare trust, we have to continue dealing with this single acquirable asset issue. So that applies both when we buy the asset on the one hand and we'll continue to own it on the other. So it means we actually have to be careful if we're changing or improving the asset. So things like buying a vacant block of land and building. The tax office says if you buy a vacant block of land using SMSF borrowing, you then can't build on it, okay, while the borrowing is there. You need to actually pay out your borrowing to do the building, and you can't build using borrowing. If we've got one block and we're going to split it to make two blocks, again, they say that's a change in asset. If we have a use, it's residential and it becomes commercial. We see it all the time with the stuff that a lot of people are doing. You're buying a house in the suburb, which is now something you want to make into a medical suite. That's probably not going to work. We need to have that all done before you end up buying. So we've got to be very careful if we're starting to play with the asset or change the asset in any way. Now, we had a question, can two doctors purchase under their own SMSF? You can only have one borrowing arrangement per SMSF. So two doctors using their super funds can buy. When we've got borrowing, we have some other issues that we need to be very careful about because two SMSFs can't have one borrowing arrangement, okay? And practically speaking, you can't have two borrowing arrangements on one property because you only end up having half a property each, and practically that doesn't work. So there are some other structures BOQ Specialist will lend to to see if that will work for you. Now, it'll work in some cases, but not others. And BOQ Specialist, one of the very few lenders who will actually lend to those multiple ownership structures. Contact the guys because they've done that quite a few times. We can make that work. Now, where we've got related parties involved, we have to be really, really careful in SMSF world. It's really important to make sure that we have a written lease in place, and the lease is in normal commercial terms and is always maintained on normal commercial terms. So if your SMSF is buying this property for lease to you, you've got to have a written lease. You have to have evidence it is on terms of that you would normally do from an arm's length landlord. And then you need to make sure you maintain the lease on normal arm's length terms. And BOQ Specialist, if you're doing this with them, will be asking for lease terms. So business premises SMSF, there are those rules and those limits. We need to make sure that the property is what they call business real property. Now, business real property is real estate used wholly and exclusively in carrying on a business. Now, in many cases, that's really, really clear. You need to have no residential use. I've been looking at houses recently. I looked at the house near where I used to live, and it reminded me that the dentist lived at the bottom of our street, and the dentist had a quarter of the lower floor was the dental practice, the upper floor and the rest of the lower floor was where they lived. Is that wholly used in carrying on a business? No, it's not. So we couldn't put that property into the SMSF. No residential use has to be wholly used in carrying on a business. At the time we buy and whenever it's being used by another entity. Okay, really important that we have that continuing. And we need to be able to confirm that everything is on arm's length terms. We need a valuation when we buy, and we need to keep the leasing on related party terms, commercial terms all the way through. That includes family members, companies and trusts, business partners, the very technical definition. So it really comes down to that, is the property used wholly exclusively in carrying on a business? All transactions must be on commercial terms. We need to have rent documented, the term, documentation, all that kind of stuff needs to line up. Now, this is all very important that we do this properly, because if we don't do it properly, then you guys, as the people who've got the arrangement, end up with some messy problems, okay? If this doesn't comply with all the rules, then your super fund can be made non-compliant. And that means you get a tax bill of 50% of the assets of your super fund, which you don't want to have. That's not a good place to be in. The ATO can impose penalties and fines on you guys for doing the wrong thing, and that can mount up because there's a few technical breaches sitting in there. Maybe you'll have to undo it. Maybe you'll transfer it out of the super fund into a family trust or back to you or sell on the market. That's going to trigger a sale. You've got new stamp duty issues. You've got new tax issues, a range of problems sitting in there. And if we're not doing everything on squeaky clean arm's length terms, you have what's called NALI, N-A-L-I, which is extra tax on all the income and the capital gain earned by the asset. So the key thing is you've got to do it right, get advice. BOQ specialists are going to be making sure as much as possible that everything lines up. There may be questions they have to ask because of things like 2 car parks or 2 lots, or any of those sorts of things sitting on their way through. So that's my section. So back to you, Luke, and there's a few questions come through. Then we can answer those at the end, I guess.
Thanks, Scott. I think you've really proved how important it is to get that advice early on in terms of structure, because the last thing you want to do is have your fund or your purchase be non-compliant, and it's important to get that advice early on. We're now going to hand over to Brad from Pitcher Partners, who's going to talk about the tax and cash flow considerations in a bit more detail.
Thanks, Luke. Well, good afternoon or good evening, everyone. My name's Brad Twentyman. I'm a director in the Superannuation Advisory practice of Pitcher Partners. For those of you who don't know Pitcher Partners, we're a full-service accounting firm. Was a spin-off out of KPMG in 1991, and we're currently about the 8th largest accounting and advisory firm in Australia. Our key clients are high net worth individuals and what we term middle market business. So the private family businesses are really our key clients, which I suspect many of you would fall into that category. My role within Pitcher Partners is to advise high net worth individuals, mainly around their tax and superannuation affairs, but I do get involved a lot in what I term transactions. So a client wants to go and purchase a property for their business or some other transaction, and I often get involved with our clients on how to structure those transactions. In terms of purchasing a property to operate your business out of, if you came and saw me, and I suggest you should go and see your accountant or your tax advisor, because where we can add value is to assess the structuring options and advise you on what we think's a best fit, depending on what it is you want to buy and the stage of life you're at, and to a degree how successful your business is currently and likely to be in the future. That will all influence what is the best purchase structure to settle the business property in. In terms of purchase structures, the common options are to purchase the property in individual names. I mean, that's advantageous because it's simple, people understand it. It's generally not as tax effective as alternative structures, and it also lacks in terms of asset protection. So for people who are at risk, what we term at-risk individuals, it would be unlikely to be structuring a business property purchase in your individual names. The other option we would consider would be a company. It's highly unlikely that a company would be our preferred structuring option because companies don't get capital gains tax discounts. So when you sell the property in the future, there'd be a sort of a tax penalty, if you like, if you structured the purchase inside a company. I mean, companies do have a reasonable tax rate in the sense that tax is capped at 30%, but that the lack of a capital gains tax discount would generally preclude a company from being the preferred structure. Where you do see companies used is in property development type ventures where there's no capital gains. All of the profits are taxed as income. So in those bigger property developments, you'll often see a company used as the purchase structure. So if we dismiss individual names and if we dismiss the use of a company, then the two other options would be a discretionary trust or a private superannuation fund. Both of them have their advantages and disadvantages. Discretionary trusts are discretionary structures where there's a trustee who looks after the assets of the trust, which may include the business property, on behalf of the beneficiaries. The beneficiaries tend to be the business principals and their families. The advantage of a discretionary trust is it has the ability to stream income to particular beneficiaries. So if you like, there's the opportunity to split income and overall reduce the overall tax rate that you'd be paying on the rent being paid into the structure for use of the business property. It has asset protection advantages that creditors aren't able to access the assets within the trust in the event of an individual beneficiary becoming bankrupt. And you get your capital gains tax discount in that structure as well. The individual distributed capital gain out of that structure can claim a CGT discount. So it has its advantages, but when you compare it with a self-managed superannuation fund, the advantage of the self-managed superannuation fund over a discretionary trust is in terms of the tax that would be paid on the profits. The other advantage that a self-managed superannuation fund can have as a purchase structure is often there's already capital inside the superannuation fund from historical contributions and earnings that can be used as a deposit. And there's also the likelihood of future contributions being made over time, which can be used to meet funding needs to be able to settle the property inside a self-managed superannuation fund. But the big advantage of self-managed superannuation funds and why people are attracted to them as an ownership structure is the tax rate that you pay on profits. Now, superannuation funds are also a vehicle where asset protection advantages are available to the fund members. But there is a striking disadvantage with a self-managed superannuation fund that you really need to be across before deciding that that's the structure that's appropriate for you, and that's the preservation rules, or the inability to access your superannuation until you meet a retirement condition. So while it sounds fantastic that you can make an investment in this type of structure and you'll pay a lot less tax on the profit and the future capital gain if you sold the property from within a superannuation structure, you do have to be conscious that you're not able to access the profits or the equity growing in the property until you meet a condition of a release, and that's generally when you retire after age 60 or when you attain age 65. So it's a very much a long-term investment structure. So you need to be prepared, I guess, to sacrifice current day benefits, current day access to profits, and as a result of that sacrifice, you do get the better tax rate that superannuation affords. So in terms of when a superannuation fund works well, I look at two elements. Firstly, it works well when you've got a reasonable deposit inside the superannuation fund to fund the property purchase, and to pay any associated purchase costs. And that can be important because the higher the deposit you have, I guess in one respect, the more substantial property you can buy, but it also tends to reduce the amount of debt funding that you need to take on to settle the property purchase. And what you tend to find is if you can keep the level of debt funding as a ratio of the purchase price of the property low, it tends to have a benefit in terms of the super fund being the right purchase structure. The other element where a superannuation fund is a good structure to consider is where it's a good property, so it's likely that it's going to receive a higher, or be able to receive a higher rental yield out of the business, because the higher the rental yield that you can flow out of the business into the superannuation fund, the more profit that you're likely to be making. So when I assess a potential business property purchase and whether a self-managed superannuation fund is a viable structure, I really look at the rent and the level of debt that you'd be taking on in settling that purchase. And assuming, as I said earlier, that the super fund is the right structure or a viable structure, you need to be comfortable with the profits being untouchable until you attain age 60 or age 65. But there's also the inability to leverage off the equity or the equity growth in the property. So you can't, once it's in there, you can't leverage off the capital growth in the property to go and do something else. So if that's something that's in your thinking, that's possible that the self-managed super fund is not the right structure. So in terms of rental yield and LVR, if you've got a high rental yield and a low LVR, chances are a super fund's going to be an option in structuring the property purchase. In between that, it's a possibility. If you have a high rental yield and a high LVR, it's a possibility. If you have a low rental yield and a low LVR, it's a possibility. If you have a low yield and a high LVR, so a high level of debt, the likelihood is it's going to be a loss-making investment, and loss-making investments don't sit very well within superannuation funds in comparison to alternative ownership structures that would be available to you. So I thought I'd just highlight a couple of examples just to reiterate what I just said. So in the first example here, we have a property purchase of about 1.5 million. We have a borrowing of 50%, so 750,000 debt funding. We've got 800,000 in our superannuation fund. We're paying an interest rate in the super fund of 5.5%. We've got a rental yield of 8%. I've got some property costs in there, and our super fund tax rate's 15%. The CGT rate is 10% inside a super fund. I mean, it can be zero. So this is worst case scenario. And I've got a cash return rate of the profits that are being invested, but it's virtually around 1% cash rates at the moment. If you contrast that with the trust, it's exactly the same set of assumptions. The only difference is I've assumed a lower interest rate for a trust, something Luke can probably expand on, but generally what I see is slightly higher lending costs in a superannuation fund compared to alternative structures, and that's because of the complexity with superannuation borrowing arrangements. But aside from that, it's all exactly the same other than the tax rate, where in a trust I've assumed you'll pay 30%, where you can usually cap income in a trust to 30% by using a company as a beneficiary, and your CGT rate I've assumed 25% inside the trust. So when you extrapolate that out, and in this example it's over a 10-year period, the rent that the super fund and the trust are deriving off the investment is 120,000 a year. The interest the super fund pays is a roughly 40,000 a year versus 34,000 a year interest paid by the trust, and that's just because of the difference in the interest rate I've assumed. So your net rent, which is effectively your gross rent less your interest costs inside the super fund, is about $80,000 a year versus $86,000 a year in a trust example. The tax cost on that net rent in the super fund, you'd be paying about $12,000 in tax a year versus $27,000 tax a year in the trust at 30%. So when you strip that out, what you're left with in your pocket inside the superannuation fund is about $68,000 a year versus $60,000 a year inside the trust. And when you extrapolate that out over the 10-year period, and this example assumes that you sell the property in year 10, at that time, assuming a pretty moderate 2% annual capital growth in the property value, the property sale price is 1.75 million in both the super fund and the trust. You pay capital gains tax in the super fund of 23,000 versus double that, 56,000, or more than double that, 56,000 in the trust. Now the rent that you've been deriving each year, the sort of 70,000, 68,000 annual rent versus the 60,000 in the trust, that's accumulated inside the structure. And inside the superannuation fund, you've got enough cash at the end of 10 years to pay off the debt. So you're left in your pocket with assets in the super fund of about 1.74 million. If you contrast that with the trust hasn't quite accumulated enough cash to pay off the debt. There's about $665,000 of cash accumulated on sale of the property inside the trust, so about $85,000 less than the super fund. So you've got to eat into your sale proceeds a little bit to repay the debt to the bank, and you're left in your pocket in the trust with about 1.63 million. So over what's really 9.5 years, it's not quite 10 because we've assumed that you sell the property halfway through year 10. There's about $110,000 difference between the super fund and the trust. So that's reasonably significant over a 10-year period. You imagine if you extrapolate that over over 20 to 25 years. And if you do something with the cash accumulating other than just hold it in cash, which is what this example assumes, that differential between the super fund and the trust would be even more significant. If you contrast that with an example where it's probably not going to work so well inside a superannuation fund, in this case, the same property purchase of 1.5 million, but we've only got a $200,000 deposit available to us, whether it be in a super fund or in a trust. So you're going to have to borrow 90% of the purchase price. Again, I've assumed an interest rate differential between a super fund and a trust of 1%. And I've also assumed that the property is not going to generate a significant rental yield, in this case at 3% versus 8% in example 1. Otherwise, all the other assumptions are the same. And when you look at the outcomes under that example, the rent drops to $45,000, being 3% of the property value versus 8%, where it was $120,000 in example 1. And your interest costs exceed the rent. In the case of the super fund, $74,000 roughly in annual interest costs versus $60,000 in a trust. So you're making a loss in the super fund of $29,000 and $15,000 loss in the trust. I've assumed a bit of a tax benefit from the loss, which would only be a benefit if there was other income in those entities to soak up those losses. But if you assume that's the case, you're making a net loss in the super fund of $25,000 each year versus $11,000 in the trust. If you extrapolate that out to the 10-year mark and you sell the property, again, you're going to be paying less capital gains tax in the super fund compared to the trust. The capital gains tax would be the same, $23,000 in the super fund versus $56,000 in the trust. And when you look at what you're left with inside the superannuation fund, you've actually lost a little bit of money. You have net assets in the super fund of about $180,000, and you've made a little bit of money in the trust, where you've got net assets of $280,000. So in that example, and based on those assumptions, it's probably unlikely I'd be looking at a super fund as a first, or as the preferred structure, unless there was something else in your circumstances that meant it was still viable, and that might be a significant contribution plan to be made in the foreseeable future, which would allow you to reduce that debt. It might be a rollover from another super fund that's coming in, or some means to inject some additional capital into the super fund that would bring the investment more to a cash neutral or a cash flow positive outcome. So one thing I think has been mentioned by Luke and by Scott already is it's important to get the order right. I have similar experience to Scott in people often come and see me and they have already made a purchase without really thinking through what the appropriate structure is. So it's very important to organise the funding first, get the structure set up prior to signing contracts, only then sign contracts once the structure's in place, and pay the deposit out of the correct entity. So I'll finish up on that point and hand back to Luke.
Thanks, Brad. I think you really touched on, with those examples, how important it is to get some advice early on what's going to be best for you and your particular circumstances. From the finance perspective, there are some differences when, in terms of the options available to you compared to from inside to outside the self-managed super fund. So generally speaking, there are lower loan-to-value ratios available in the market. So you would need to potentially contribute a higher deposit than you would if it was outside of the self-managed super fund. So your property trustee company and as an individual. Principal interest is generally always required from a pay down point of view, irrespective of the loan to value ratio. Whereas outside of your self-managed super fund, we can generally negotiate an interest-only term, especially at the lower LVRs. And someone asked, what does an LVR stand for? It's loan to value ratio. So if you've got a property worth, say, $1 million, and you have a loan of 800K to it, then you would have a loan to value ratio of 80%. On both options, there are fixed and variable options available. So we can structure the loans so that it makes sense, whether it be part fixed or part variable as well. There are some costs associated with both in and outside your self-managed super fund. So these will include your lender costs, your valuation costs, and also some legal fees. So we find that the legal fees are slightly more than in your self-managed super fund than outside. The reason being is that it is just a little bit more complex than your normal transaction. It's also important to make sure that you get your structure correct because it can be costly if your fund is deemed non-compliant with the SIS Act, which Scott mentioned before. It's also an important point to make if you do have a property that's currently sitting outside your self-managed super fund, talking about your practice premises, and that you're looking to sell this into your self-managed super fund, then you must sell this at market value, and there would be stamp duty applicable. Some considerations. So in terms of the income that we look at to help cover the loan repayments, we look at your ability to make personal contributions, but we of course recommend speaking to your accountant before you do make any personal contributions towards your super. There's your compulsory super guarantee payments, so your 9.5%. There's the rent that your self-managed super fund is going to receive from the tenants. And in this situation, it would be your practice entity being your own occupied property. And you might also have other tenants in that property as well. Also, other investments and income that the self-managed super fund might have as well. Also, be aware of paying down the loan too quickly. So once you've paid down the loan, you cannot redraw funds in a self-managed super fund. One of the questions that has been asked, and it is a bit of a difference maker, is that at BOQ Specialist, we can lend up to 90% of the loan to value ratio for your own occupied practice premises in the self-managed super fund. So we see a lot of the other mainstream lenders around the 65% mark. So in those situations, you would probably need to contribute a higher deposit than the minimum 10% on our end. In saying that, we always recommend getting advice from Brad and your accountant. I thought it'd be good to go through a bit of a case study. So in this example, we've got a specialist dentist that is acquiring their practice property in a newly established self-managed super fund. So they're currently in the property they're renting. So they've had some negotiations with the landlord who is agreeing to sell. So your first port of call would be to engage your accountant. And he's going to want to know, or him or her is going to want to know or some key questions. Some of the questions that he'll ask will be what LVR is acceptable, which is we can do up to 90%, interest only or principal and interest. We can do principal and interest. What is the term of the loan? So the term of the loan, our minimum required pay down is 10% of the principal paid down over a 5-year period. Take, for example, this situation. The purchase price is $1 million, and he's looking to make a 20% deposit, so contribute 200K. So the loan amount will be 800,000, and we only require 10%, so that would be 80K of the principal paid down over a 5-year period. There's going to be lender's costs, legal costs, and valuation costs associated. And also, what will the government stamp duty be, or will the government duties be? This is different in each state, so we do recommend you getting some advice from your solicitor or conveyancer to confirm what the stamp duty is going to be for your particular property, because you do need to factor in this figure for your contribution. So ensuring that you have enough in your super fund to be able to cover the stamp duty and the costs. The last question is probably one of the most important questions. Is there a minimum amount of super that I need to have in order to apply for a loan? The answer is yes. The preferred amount from BOQ Specialist is that we would like you to have at least 400K in net assets within your super fund. So a couple of ways which this can be worked out. So if you had 400K in a retail super fund, then that's great. Or in a self-managed super fund, then that's fantastic. You satisfy that requirement. If you have an existing self-managed super fund and you already own a property in it, you might own the property and it's worth about 700,000, and you have a loan for 400,000. In that situation, you have 300,000 in equity. You might also have another 200,000 in cash. So the 300,000 plus the 200,000, it's 500,000 in net assets. So that would also satisfy that requirement. In saying that, if you don't have that 400,000 and you're going to fall a bit short, please still engage with us, because we do look at each application on its merits, and we have done and will do self-managed super fund loans whereby we don't quite meet the 400K mark. So please still engage with us, and we're more than happy to look into it for you. So Brad has agreed. He said, yes, look, this sounds like a good way to go about it in your self-managed super fund. The specialist dentist has approached us again and would like to go ahead with a loan application. The type of information that we would require is just some basic information in terms of your background, how long you've been in practice for, and just some really brief basic information. The other information that we require is generally your financials. So this would be your practice financials, but also your personal financials and tax returns as well. We like to have the last 2 years worth. So it is important to try and keep up to date and have your financials and tax returns ready to go if there is a purchase you want to act on quickly. We also look at your assets and liabilities. So this is just a 1 or 2 page form to fill out, really simple. It's certainly a lot less stringent than your home loan application. And also in this situation whereby the client doesn't have an existing self-managed super fund, he's not going to have self-managed super fund financials available. So in this instance, we would have statements for the industry super fund statements to show the balances and the contributions for the last year. So once we've collated all the information, we're doing a finance approval based on an estimated or an agreed purchase price of $1 million with a loan amount of 800K. We don't require a contract of sale in order to do an approval or a pre-approval. We can do it based on an estimated or a likely amount. So our credit team have then reviewed all the applications, and they've given us the finance approval, which is great news. However, this is also subject to a evaluation. As Scott and Brad mentioned before, we do need a contract of sale in order to request a valuation to be conducted. So in order to have a contract of sale, you do need to have your self-managed super fund and bare trust details available, given that the bare trust would need to be on the contract of sale. So basically, once we've got the contract of sale, then we will instruct our valuation team to organise the valuation. And in this situation, the valuation has come in at $1 million, which is the purchase price, which is exactly what we're looking for. As Scott mentioned before, a lease agreement will be drawn up between the tenant and the self-managed super fund for the rental agreement. At the same time, we are also preparing loan and mortgage documents. So the loan and mortgage documents will reflect the $800,000 loan, 80% loan to value ratio. You'd need to be able to contribute the 20%. So that would be the 200K, but you also need to factor in the stamp duty, assuming say 5%, and other costs and a buffer that may be in place as well. From a loan perspective as well, we do also require some insurance over the property. On the valuation, it will generally give us a minimum insurable amount. So we will let you know what that is. The insurance policy also needs to be in the bare trust entity, given that that owns the property, and the bank needs to be an interested party on the policy. So we've compiled all the documents, and as a result, the settlement has now taken place, and the self-managed super fund owns the practice property. There was a fair bit to unpack there, and a bit of information. So what we're going to do now is I'm going to just quickly look through the questions, and we'll go through any of the questions that were asked. But here's also our contact details. So we are more than happy to go through any questions that you may have. I'm also happy to introduce you to a colleague of mine in your own state, so you can have a local relationship. But we're more than happy to help where we can. Is it possible for a self-managed super fund to own more than one property? Presume can only own one premise to operate from based on first speaker. I will throw this open to Scott, and he will go through this in a bit more detail.
Hello. Yep. No, you can have many properties in your SMSF. You can have as many used as business or property as you want to. The problem you get is that you can only have one SMSF in one bare trust.
Thanks for that, Scott. Another question was that if your building requires a modification, can the renting company borrow for funds for Medicaid for the modifications and the fit out? I think you touched on that a little bit briefly before.
Yeah, okay. Yeah, the answer is it depends on how extensive the modification is. It's not who does it, it's does the asset change. So typically the tenant would not usually get finance. There's a finance issue sitting in there as well. They lend, well, someone like BOQ Specialist lend to you as a tenant to do it, probably not. And the question is more about is the building changed, not who changes it.
Thanks, Scott. Another one here for you. If you have two doctors who own one property under their self-managed super funds, 50% each, I think you might be referring to potentially a unit trust arrangement. How does one doctor sell their share?
Yep, that's a real issue. So where you've got people going into one piece of real estate to go through SMSF, that can be a real problem. There's no easy answer to that one. One can buy the other one out sometimes, but not always. It may require the whole structure to be undone. So commonly you sell the whole thing, or you bring a new doctor in and the new doctor is replacing the one who is exiting. But no, there's no easy way once you're with your business partner.
And Brad, one for you. If you can a husband and wife combine super and either buy or borrow?
Oh, well, husband and wife are permitted to be members of a single self-managed super fund. So yes, it would be possible for a husband and wife to pull their superannuation to undertake a geared property investment inside a self-managed fund.
Thanks, Brad. And does BOQ require a personal guarantee for self-managed super fund borrowing due to the limited recourse borrowing mortgage? Yes, we do. So it is standard practice on just about all of our loans that we do take personal guarantees. And it is, I guess, especially relevant in the self-managed super fund space where we are only limited to the single asset in the self-managed super fund. So we do take personal guarantees as well, but we are only limited to that single asset in the self-managed super fund. And is it possible to use the property under the self-managed super fund for multiple purposes, medical clinic and office space rental to a third party? I might throw that one to you, Scott.
Yep, look, absolutely it is. The limitations are that if you are transferring it into your SMSF, it must be used by someone or someone wholly and exclusively in carrying on a business. And that if you, as the people who are behind the SMSF are using it, it must be only used in your business. So problems we get are if I'm going to rent it back from my SMSF, then I must use it wholly in my business. If I'm selling it into my SMSF, then we can have multiple business uses, but no non-business residential uses.
And I'll just go a bit further from the lending point of view. So we can do up to 90% for owner-occupied property, whereby there is a large investment portion in that property. We do generally have a slightly different approach. For commercial investment property, our loan-to-value ratio is about 55%. So that's purely investment where you're not occupying it. So if it is going to be, I guess, a mix of owner-occupied and investment, we generally might meet in the middle, depending on at what level or I guess what portion of the property is used for owner-occupied and what portion is going to be used for another tenant. But we can, of course, look at each case on its merits and on its basis and give you some feedback on that as well. Sorry, there's just a couple others. Please comment on two properties, one on top of each other as one or two purchases, and car parking Melbourne, where the parks are connected to the lot numbers with a body corp. Scott?
So if you have two properties on top of each other, if they are the same property on one title, we're okay. If they're two separate lots, we have two bare trusts. Okay. Car parking, if you can't sell the car park separate to the lot, then you can have one bare trust. So in Queensland, that example of the exclusive use of the body corporate, that's one lot. Sydney, where you've got separate lot, separate car parking, that's two lots. Melbourne, if you've got one car parking and the lot that's all just one lot, you can't sell separately, that's one bare trust.
Great. Also, if the property you wish to purchase has already mixed use, lower floor business, sorry, that one's I think already been covered. Okay, a family trust is currently building a cold shell structure. Can I sell it into self-managed super fund as off the plan arrangement? Scott?
Only if it is actually used in carrying on a business at the time of the transfer.
And can two bare trusts buy one property?
Yep. Technically, yes, but practically no, because that would require two separate loans and your security is only over part of the property. and generally no one will lend on part of the property.
And we mentioned husband and wife joining their super. What about de facto?
De facto is included. That's within the husband and wife, or the relative definition. So a relative includes husband, wife, and or de facto partners.
And can the tenant borrow for fit out and later rent per commercial terms to self-managed super fund? I think potentially, can for the...
A tenant can't transfer those little items into the super fund.
Yeah. We can lend to the tenant being the practice entity for the fit out, but as Scott mentioned, it's not going to be able to be transferred in.
But you do see that arrangement quite a bit where the business using the property fits out. I mean, it's all demountable and can be picked up and taken away. That can be treated differently to the property purchase by the super fund.
Yes, but you can't transfer the demountable into the super fund.
No.
Yeah.
Correct.
Yep. So the lending would be against the practice entity rather than the super fund. I think that just about covers most of the questions. I'm just seeing if there's any new ones.
It just looked like there was a couple of questions around, business partners, whether they be two dentists or two doctors being able to do something together. I mean, from my experience, there's always an option available for people to do those types of things. The unit trust is an example where it's common for two parties to come together to do something together. We've also set up special purpose self-managed funds, so where there's two unrelated families who are in business together and they want to do something together inside a super fund. Sometimes we've set up a special purpose super fund, and each business partner brings their super across, and we do something in that structure, and then that can be collapsed when they decide to sell the property. But I think Scott raised an important point before, that you really need to know how you're going to get out of that type of structure before you get into it.
Yeah, that's the catch. Is once you've got the more people in SMSF, the harder it can be to pull apart if they want to leave or there's a dispute or something else happens. Yeah, but
you often see people who'll do like unit holders agreement or some sort of deed of agreement as to how they will unwind that type of structure if one of the parties wants to leave.
One of the other questions was, can BOQ lend 100% for a medical practice within a trust? Yes, we can. So it's 100% outside of super fund and up to 90% within the self-managed super fund. Should I put a lease in place with a trust first, then sell to self-managed super fund? Is that a better strategy than leasing with my self-managed super fund?
Where have we gone? For me, not necessarily. It might be, but not necessarily. Need more information to see where that would work better.
Self-managed super fund has no debt. Can tenant leave fit out with self-managed super fund when lease is over? No limited recourse borrowing arrangement.
If it's an arm's length tenant.
Thank you. Can two separate entities, for example, two doctors, one using their self-managed super fund and one using their trust, is that feasible or not advisable? Or would that be, I guess, more of the unit trust structure potentially in that situation?
That's right. So that comes down to a whole lot of really messy technical SMSF issues about how the two doctors are connected. If they're not connected, we're okay. If we are connected, that's a problem for the SMSF.
And last question for the night. Can the self-managed super fund pay for the leasehold improvements?
It depends what it is being done. So the issues around that become, are we changing the asset? Is it a fixture and belongs to the land rather than being a dental chair which can be removed? So sometimes, yes.
Great. Look, I want to thank everyone for joining us this evening. I hope you found it useful. Please feel free to reach out to us if you have any questions. We're more than happy to go through any questions direct. So look, I hope you have a great night, and thanks again for joining us. Thank you.
Thank you.
Bye.